Most people are misreading XRP and the entire crypto market right now. Over $2 trillion has been wiped from crypto since the October 2025 peak. Fear is exploding, and more than half of holders are now sitting on unrealized losses. Moments like this have historically marked some of the most important turning points in market cycles. In this video, we're going to break down the data behind the collapse, the role of institutional flows, why ETF activity is getting so much attention, and what the current market structure may be telling us about where we are in the cycle. Let's start with the numbers. Since the October 2025 high, the cryptocurrency market has lost more than $2 trillion in value. The entire market is corrected by roughly 48%. Let that sink in. Over the past several trading sessions, selling pressure has hit virtually every major asset. Bitcoin, XRP, Ethereum, Solana, Cardano. And while prices have been falling, another metric has become even more important. More than 50% of Bitcoin holders are now holding at an unrealized loss. The same dynamic is appearing across large parts of the crypto market. That's significant because when the majority of investors are underwater, market psychology changes. Fear replaces optimism. Investors stop asking how high prices can go and start asking how much further they can fall. But here's where it gets interesting. The last time we saw conditions like this on a large scale was during one of the darkest periods in crypto history. And what happened next may be more relevant to today's market than most people realize. Quick disclaimer, this content is for informational and educational purposes only and not financial advice. Always do your own research before investing in anything. With that said, let's continue. One of the biggest mistakes investors make is assuming that bottoms feel like bottoms. They don't. Bottoms feel uncomfortable. Bottoms feel uncertain. Bottoms feel like the market could continue falling forever. That's because price isn't just reflecting fundamentals, ladies and gentlemen. It's reflecting emotion. And right now, emotion is dominating the conversation. Social media is filled with fear. Headlines are increasingly bearish. Many investors are questioning whether the bull market is over entirely. But market history shows that maximum pessimism and maximum opportunity often appear much closer together than most people expect. Not always, but often enough to deserve attention. To understand why this matters, we need to revisit late 2022. The collapse of FTX sent shockwaves through the entire cryptocurrency industry. Billions of dollars disappeared. Confidence evaporated. Investors questioned whether crypto would ever recover. At one point, more than half of Bitcoin's supply was being held at an unrealized loss. The environment looked hopeless, but underneath the surface, something else was happening. Long-term capital was accumulating. While retail investors were exiting positions, larger investors were gradually building positions. Let that sink in, ladies and gentlemen. Eventually, selling pressure exhausted itself. The market stabilized. Accumulation replaced capitulation. And an entirely new cycle emerged. Now, this does not mean today's market will unfold exactly the same way. History never repeats itself perfectly, but investors pay attention when similar conditions begin appearing. If you're enjoying the breakdown like this, make sure to like and subscribe and join the Wolf Pack. It helps the channel a lot. Now, with that said, let's continue because this next part is where it gets even more interesting. Fear is one of the most powerful forces in investing. When prices rise, investors become increasingly comfortable. Risk appears smaller. Opportunities appear larger. When price falls, the opposite occurs. Risk suddenly appears enormous. Opportunity disappears from view. The underlying asset may not have changed dramatically, but perception changes dramatically. That's why experienced investors spend so much time studying sentiment indicators, because sentiment frequently reaches extremes near major turning points. Now, this is what most people miss. Markets do not move because everyone agrees. Markets move because expectations change. The crypto market of 2026 is very different from the crypto market of 2017. Institutional participation has increased dramatically. Large asset managers now have direct exposure. Major financial products exist. Institutional capital can move billions of dollars through crypto-related investment vehicles. That changes market behavior. It changes liquidity. It changes volatility. And it changes how investors should interpret price action. Let that sink in. Recently, Bitcoin ETFs have experienced significant outflows. Billions of dollars have exited these products over a relatively short period of time. That has naturally led investors to ask a very important question. How much influence do ETF flows have on crypto prices? The answer is more nuanced than many people realize. See, ETFs inflows and outflows matter because they represent large pools of capital. When demand enters the system, it can create buying pressure. Capital leaves, it can contribute to selling pressure. The key point is that institutions operate on a scale that most retail investors simply cannot match. Billions moving through a market can create meaningful effects on liquidity and volatility. That doesn't automatically imply coordinated manipulation, but it does mean investors should pay attention to what capital is flowing, because capital flows often tell a different story than social media narratives. Short-term noise, long-term structure. That distinction becomes incredibly important during periods like this. See, price is what everyone sees, ladies and gentlemen. Structure is what few people study. Prices can fall rapidly, but structure can improve simultaneously. See, prices can rise rapidly. Structure can weaken simultaneously. The two are not always moving together. Write that down. That's why sophisticated investors spend time analyzing liquidity conditions, positioning, and market participation rather than focusing on daily candles. Because price is reacting, the system's evolving, and those are not always the same thing. Another topic receiving attention during this correction is wash trading. Wash trading refers to activity where the same assets are repeatedly bought and sold to create the appearance of volume. This can generate the illusion of demand. It can create the appearance of market interest, and it can influence how much investors interpret market activity. The concept itself is not unique to crypto. Financial history contains numerous examples of market participants attempting to influence perception through volume and activity. That's why volume alone should never be treated as definite proof of genuine demand. Context matters, liquidity matters, and understanding who is participating matters. In smaller markets, ladies and gentlemen, a common pattern always and can emerge. Early participants accumulate positions. Activity increases. Volume rises. Tension follows. See, social media amplifies the story. New investors enter, prices rise rapidly, then early participants begin selling into the demand they helped create. The cycle repeats. This process is significantly more difficult to execute in highly liquid assets like Bitcoin. But understanding the framework helps investors recognize how sentiment and volume can sometimes create misleading signals. Think of today's crypto market like an ancient city undergoing reconstruction. Most people only see the disruption. Roads closed, traffic delayed, construction everywhere. It feels chaotic, but beneath the surface, foundations are being strengthened. Infrastructure is being upgraded. The visible discomfort often hides the invisible improvements. Markets can behave in much the same way, ladies and gentlemen. See, volatility is often viewed as a problem. For professional investors, volatility can also be an opportunity. Large swings create mispricings. Mispricings create opportunity. Fear creates opportunity. Uncertainty creates opportunity. This doesn't mean institutions control every move. But what it does explain why periods of panic often attract sophisticated capital. Write that down and let that sink in. This is so important. Just paying attention to that one thing will give you an edge. The environment that scares retail investors away can sometimes attract long-term holders. And that dynamic has existed throughout financial history. Consider the financial crisis of 2008. Fear dominated global markets. Many believed the financial system itself was at risk. Asset prices collapsed. Confidence vanished. The outlook appeared overwhelmingly negative. Yet some investors were accumulating, not because conditions were good, because price had adjusted dramatically relative to future expectations. Years later, those decisions proved highly significant again. Crypto today is not 2008. I repeat, crypto today is not 2008, ladies and gentlemen. But investor psychology remains remarkably similar across generations. See, everybody wants to buy the exact bottom. Almost nobody does, because bottoms are only obvious after they occur. When you're living through them, uncertainty dominates. News remains negative. Prices remain weak. Sentiment remains poor. That's why experienced investors focus on probabilities rather than certainty. Certainty rarely exists in markets. Probability is what matters. Imagine standing on the wall of a medieval fortress surrounded by thick fog. Your visibility becomes limited. The landscape hasn't disappeared. Your ability to see it has. Market crashes often create the same illusion. Investors mistake uncertainty for permanent change. They confuse temporary fear with permanent reality. And that distinction matters. Professional investors tend to monitor different variables than retail investors, ladies and gentlemen. Liquidity, positioning, sentiment, capital flows, risk appetite, market structure. These indicators help reveal what money is actually doing rather than what headlines are suggesting. That doesn't make institutional investors perfect. Far from it. But it does explain why understanding capital flows can provide valuable context during periods of extreme volatility. For XRP holders, one of the most important lessons is that XRP, the anointed one, does not exist in isolation. Bitcoin matters, liquidity matters, macro conditions matter. Institutional participation matters. The broader market environment influences everything. Understanding the ecosystem is often just as important as understanding the asset itself, because major trends typically affect the entire market, not just one cryptocurrency. So what happens next, ladies and gentlemen? Nobody knows with certainty. Anyone claiming certainty is guessing. What investors can do is monitor the entire situation and the evidence. Watch liquidity, watch sentiment, watch capital flows, watch market structure. Some analysts believe the market may be entering a bottoming process. Others expect additional volatility. Both outcomes remain possible. That's why objective analysis matters more than emotional reactions. Ladies and gentlemen, the most important takeaway from this correction is simple. Fear and opportunity frequently arrive together. More than half of crypto holders are underwater. Billions have moved out of major ETF products. Sentiment has deteriorated significantly. Yet history repeatedly shows that periods of maximum pessimism are often the moment investors study most closely. Not because every decline immediately reverses, but because major turning points often emerge when confidence is at its lowest. Short-term noise, long-term structure. Prices reacting, systems evolving. That's why I always tell you, ladies and gentlemen, pay attention to what's quiet. If you have enjoyed this analysis, make sure to subscribe, join the Wolf Pack, and turn on notifications for ongoing coverage of crypto markets, liquidity conditions, institutional development, and macro trend shaping digital assets today, and my rant that's coming right after this. Stay tuned for future videos. Thank you for watching. Remember, don't get caught up like sushi, because short-term noise, long-term structure, prices react and the system's evolving. Always pay attention to what's quiet. I'll see you in the next one. Have a blessed day. Happy Saturday, everybody. The time of this recording, it's early. I love working Saturday mornings. It's my favorite time to work. I want to welcome all the new members of the Patreon, the Crypto Public Desk Monthly, all the new members of the membership channel. Remember, ladies and gentlemen, if you're looking to learn how to trade and you're looking for mentorship, come and join us. One good tip from the pits can easily pay for your entire year subscription. You want the deeper macro research and to learn how to take advantage of all this, come and join over 570 active traders and investors inside the Patreon, the Crypto Public Desk Monthly. On days like yesterday, I fully understand what it means to be a financial mercenary. See, we wait for these things to happen. Again, I go back to what I said when we exited our Bitcoin long. There was a reason why. I would rather get out when the market's moving higher than wait for it to crest and start to come down. I was taught that on the floor of the New York Mercantile Exchange. See, why we're the remora, ladies and gentlemen, is we're following the apex predator. We get a free meal. And why we're the wolf pack is because the wolf is not the mightiest animal in the jungle, but it doesn't do tricks at the circus. See, we're paying attention to flows. That's why I always say people got to make their weekly numbers, their monthly numbers, their quarterly numbers. We went over what Bank of America reportedly was saying. Okay, they saw 122 billion, move into cash in a single week. Do you realize that at the same time they saw 39 billion go into bonds? It's so crazy because crypto saw a $2 billion outflow. That's the biggest outflow since 2025. Okay, so when you see what's happening, and there may be more kinetic action in the Middle East, but the kinetic action never stopped. It never stopped. Pigs get slaughtered, hogs get fatter, ladies and gentlemen. I tell you this all the time, okay? That's the most important thing. So when you see money flowing from one place to another, that's what you're paying attention to. We follow what large investors are doing. See, our organization doesn't work for retail people. We're not retained by retail people. So I'm not used to talking to retail customers. None of this is financial advice. This is just my own opinion, and it retains any capacity. Again, because when you follow what private client banks do and sovereigns do, we understand what they're thinking and why. See, the market's not about what people say, ladies and gentlemen. It's about what people are doing with their money. See, money leaves a footprint. We follow the flow of money. That's the biggest thing I was taught as a financial mercenary, that I was started to be taught this at 15 years old. So when you look at what Bank of America is talking about, 46 out of 68 global central banks are currently overshooting their inflation targets. Do you realize how important that is? 46 out of 68. What that means in English, taking a PhD out of PhD, the majority of the world's central banks are still fighting inflation despite years of tightening. That's rough, because higher interest rates leads to alpha and yields on holding certain types of assets. It makes gold look less attractive. Metals look less attractive. Anything that doesn't pay you to hold it looks less attractive. Risk assets only look delicious when interest rates are close to zero, because at that point, you want to be in all risk. But ladies and gentlemen, what if the central banks don't have everything under control? What if inflation isn't dead? What if inflation simply paused? What if people are going to look at expanding economies with an inflation rate of over 3%? That's what the data is really telling us when you look at it, right? Because look, U.S. inflation, if it moves back above 5% before the midterm elections, on a historical standpoint, that's not good. Because when inflation crosses 4%, the S&P 500 has averaged the decline approximately 4% over the next 3 months and nearly 7% over the next 6 months, okay? So what does that mean? See, history doesn't repeat itself perfectly, but if you're looking at people got to pay attention, that means the risk profile is changing. And most investors are acting like nothing has changed. Again, if you look at household wealth, stay with me here. It continues going higher. According to a Bank of America report, U.S. households' equity is already up $6 trillion this year, following a $10 trillion 2020-25 and $9 trillion 2024. Ladies and gentlemen, that means there's a lot of wealth being created and it's parked in places. That means the people that control the wealth, people like us, we move things around. I love our YouTube channel. It has become one of the greatest versions of charity that our organization, myself, give back. We make a living by what we make, a life by what we give to others. I love coming here, answering everyone's comments when I get a chance to. I love everybody in the Patreon. I love the camaraderie in the group chat, everyone talking. I love it. And the fact that everybody understands where they want to go, why they want to go, and how they're going to get there, that's the greatest Gucci conviction clarity ever. But getting back to flows of money. See, ladies and gentlemen, if you're looking to learn how to trade, or you want someone to do it for you, that's why we have our tips in the pits. They cover everything. Currencies, commodities, equities. There's something for everything, because we, as financial mercenaries, trade everything there is. This is what a private client bank does and family offices do. Physical, trading, speculation, hedging, arbitrage, everything, bank setup. But ladies and gentlemen, there's something called the wealth spiral. See, people feel wealthier, people spend more money. Spending supports growth, growth supports earnings, earnings support stock prices. Higher stock prices create more wealth. And that cycle really feeds itself, right? So you would think it sounds really bullish, but inflation could cut into that because what a Hershey bar costs today is not what a Hershey bar cost 50 years ago. And what we believe is going to happen with Operation Print It to Win It, we're going to export ourselves out of this. So you will try to increase exports and decrease the value of the dollar. That's got issue when you got interest rates viewing to go higher because people want to buy the dollar. So if you look at the DXY sitting at over 100, almost at 101. But ladies and gentlemen, what is happening right now is very, very scary and very, very opportunistic. See, I am genetically bullish. I have been bullish since that was drilled into my head, or might as well tattooed on my forehead, when I started on the floor of the New York Mercantile Exchange, and I put down the Dungeons and Dragons Lord of the Ring book, when the floor trader Lucky, when I was sitting in the gold pit, said, Dom, why don't you pay attention to this? What do you think? What do you say? Let me tell you and show you a different kind of magic. See, most investors only look at price. That was one of the biggest things he taught me. Professionals, we look at cause and effect. This is where things become more interesting, ladies and gentlemen. When you look at cause and effect, that is the most important thing. According to the Bank of America's Bull and Bear indicator, which is at 8.7%, that's in a firmly sell signal territory. See, historically, there have only been 17 similar signals since 2002. Average drawdowns after weren't catastrophic, but they were meaningful, typically 2 to 3% declines over the following month, with some periods seeing drawdowns as large as 15 to 20%. So now, before people start panicking and start screaming, crash, the sky is falling, lions and tigers and bears, oh my, that's not what the signal means. What it means is that optimism is becoming crowded. Everybody's leaning to the same side of the boat. And when position becomes crowded, ladies and gentlemen, markets become very fragile. I'm repeating myself because I'm trying to drill this into everybody's head. See, the strongest rallies don't happen when everyone is bullish. They happen when nobody believes. This is the thing most investors never learn. As financial mercenaries, is drilled into my head. This is how you don't get caught up like sushi. No. See, even with Jesse Livermore talking about position sizing, how speculation, it's an occupation, it's a job. You have to be able to outlast the market. Most people are getting annihilated right now. Even look what happened with Zcash getting whacked. But ladies and gentlemen, if you follow a plan, if you have a plan, you know what you're doing. A carpenter, when he builds a house, he follows a plan. He measures. A mortgage broker, a big shout out to all our mortgage brokers in the Patreon. Everybody, love you guys. They follow DTIs. They know what you can afford to your monthly payment or not. And it doesn't matter what you say to them, what not. I know. I mean, you can afford what you can afford. If the math's not math, it doesn't math. Ladies and gentlemen, another fascinating development is happening right now globally. See, I love currency trading. One of our first hedge funds was a FX hedge fund. I'll never forget that. I told everyone I bought my first house with a carry trade with the Japanese yen. See, we look at the opening to Japan. We look at the Widowmaker. So if the Korean won, which you're watching, is approaching levels associated with major historical crises, the Indonesian rupee has reached record lows. Ladies and gentlemen, multiple emerging market currencies are under pressure. That tells us global liquidity isn't flowing evenly. Stress is emerging underneath the surface, ladies and gentlemen. See, all the financial markets to us plays a role in everything. It's like the weather. The weather patterns focus everything. If you follow weather patterns, you can make money. See, when liquidity tightens, global speculative assets tend to feel it first, ladies and gentlemen. Not always, but immediately, but eventually. See, this is why macros matters. This is why capital flows matter. This is why simply staring at a crypto chart without understanding the broader system can be dangerous and useless. And that's why we get the comments below that people are disappointed that we make a video and it goes lower. Come here and vent with the rest of the wolf pack that you're disappointed. This time period will pass, and we will remember this as nothing more than turbulence on a plane ride on a family vacation, ladies and gentlemen. See, crypto doesn't exist in isolation. It exists inside of a global liquidity framework, That's the biggest thing. See, retail investors, they're gambling with rent money. Private client bank clients are not. So when I look at allocations currently, they got 66.1% equity, 17.2% in bonds, 9.6% in cash. That tells me a story. The smart money's still participating. They're not hiding in bunkers. They're not expecting the world to end. They're becoming more selective, more tactical, and more data-driven. That distinction matters because there's a huge difference between being bullish and being blindly bullish. One of the biggest mistakes investors make is assuming every correction is bearish. Many corrections are actually opportunities. So the market transfers assets from emotional participants to patient participants. That's what it's always done. See, ladies and gentlemen, the crowd buys strength. The professionals, we buy value. The crowd buys a narrative. Professionals, we buy mispricings. The crowd reacts. See, professionals, we prepare. And when you study history, you realize the largest fortunes were really built by chasing what was popular. They were built by identifying what was misunderstood. Pay attention to what's quiet. That's why all I do is this. I'm designed for this, forged in the financial chaoses of combat. That's all. That's why I spend so much time studying liquidity, trends, flows. I have forgotten more about finance than most people will ever remember. It's not a competition. That's why our office every day, at least our organization, gets offers from AI companies to train on what we do. But AI can't do this. It's algos. We have our own black boxes that we follow on everything. There's no magical AI that can teach you to trade, ladies and gentlemen, because they're all keying off of something else. AI can't read the news and understand emotion. It just can't. See, I spend so much time studying flows. I spend so much time studying positioning because price tells you what happened, but flows will tell you what is happening. Understanding that is the difference that changes everything. Because when billions move into cash, when bonds receive record inflows, ladies and gentlemen, when inflation pressures begin appearing, that's when positions reach extreme optimism. When global currencies begin flashing stress, you don't ignore these signals. You study them. You prepare for them. You build a framework around them. Because opportunities don't appear randomly. They emerge when preparation meets dislocation. And if dislocation appears over the coming months, the investors who have done the work beforehand, if they're recce, will recognize them immediately. Everyone else will be reacting after the move has already happened. And that's the difference between following markets and understanding markets. That's the difference between cut up like sushi and feasting on the sushi, ladies and gentlemen. I think there's going to be more fighting, but it never ended. See, what we're worrying about right now is we're paying attention to the systematic lows in oil maintenance levels around the world. That's what we're paying attention. See, we believe at some point demand destruction will catch up to what's happening. See, you'll first see it in motor oil. So if you, my financial advice is my opinion, if you're waiting on a good time to get your oil change in your car, it might be a good time to do that right now. But I want you to understand something. Gold bounced off the 4,300 level, didn't close below that. Oil sitting at $90.24. Silver sitting at $67. At the time of recording our video, let's just look at the cryptos right here. We got cryptos, ICP, $2.29. XRP, $1.09. Bitcoin at 60. Ethereum at 1,555. Ladies and gentlemen, it tells a story. When I always talk about position being small, they should be small enough that, yeah, you're disappointed if your positions are down, but it's no different than deciding what you're going to wear today because of the weather's, or what you're going to eat for breakfast. Are you going to have black coffee or green matcha? Different day, different taste. You have to understand something. The world is in a state of influx. Why I say this is the last time, at least in my lifetime, and I'm 47 years old, for a chance of generational wealth through a new market, because I look at the blockchain, the crypto space, as the ultimate land grab in natural resources. Our organization outfit has been taking things out of the ground for the last 20 years. That's why when we spoke everyone about sulfuric acid, all this sulfuric acid that our refineries create throughout Indonesia is spoken for in Oceania. That's why when we gave out the calls for nickel, we knew that there's not enough sulfuric acid for leaching, for copper, when we told you about the certain plants in Northern Africa. The difference is I look at these situations and I go all the way down from cause and effect, from the shortage of A all the way down to the stock and the refinery in what country it's going to affect and what currency I can take advantage of that. That's what I spend so much time. I was talking to a family office today saying to myself about how we're going to be able to speculate in an arbitrage for stable coins, equities, domestic currency, and time of value. All of those are going to play a role, and the overlying commodity price at the refineries in certain geographic countries around the world is going to play. And we're going to play that everywhere there's major refineries in different countries. We're going to play the currency domestically, a stable coin to take advantage. This is why I love XRP and RLUSD. I'm not going to give that away for free because I can't, because I just can't, right? But at the end of the day, that's what I look at and I get so excited about what's happening and why. See, most people are afraid of what's happening. I remember when I was in college, an email came out. I remember I almost failed a class because I didn't want to use email. I thought email was annoying. I'm like, well, what is this? Even to this day, I don't like computers, but email was coming. And I didn't email my paper to a professor. I figured I would just go give it to him on Monday, but he wanted to email them on Saturday. I didn't email it. I thought, okay, it'd be no big deal, right? He failed me. Failed me. Never forget it. Failed me. The dean of finance in undergrad failed me. And I was a TA with derivatives. Failed me. It told me, he said, Dom, there's something called email. It's the future. You should learn how to use it. I'll never forget that. Now look where email is today. Amazing. Ladies and gentlemen, if you're looking for help and you want to learn how to trade and you want to learn how to take advantage of all the chaos happening, come and join the Crypto Public Desk monthly. One tip from the pits can pay for your entire year subscription. It's that easy, ladies and gentlemen. Our members are enjoying life-changing results. I love you all, ladies and gentlemen. None of this is financial advice, just my own opinion. Everything is any capacity. With that being said, have a blessed Saturday. I'll see you on the front lines. I'll see you tomorrow at 3 as well. I love you all. None of this is financial advice. Always do your own research and never invest based off of a YouTube video. Always do your own research. Don't get cut up like sushi. Hold the line. Gucci conviction. Gucci clarity. We're walking up this frosty mountain, drinking our frosty beverage together, ladies and gentlemen. Nobody said this would be easy, but it'll be worth it when we look back. I love you all.